You're listening to the AZREIA Show. If you're looking for quality real estate investing information that you can trust, you've found it. Stay tuned and join the tens of thousands of members that have already benefited from AZREIA, your home for education, market information, support, and networking opportunities that will advance your real estate investing career.
Hello and welcome to the AZREIA Show. This is your weekly dose of real talk, real deals in real estate right here in Arizona. I'm your host, Marcus Maloney, and we have our co-host, Mike Prete.
Good morning.
And today's episode, we have Dr. Harold Wong, who is PhD. He's a CPA. So welcome to the show, Dr. Wong.
Glad to be here. I'm going to tell some things that are going to stun people in the real estate field. It's going to be different than what most people in the CPA field say.
Because you take a very controversial approach when it comes to CPA and tax savings, and it's a different approach. So you guys that's listening, just make sure you grab your notepads, your pencils, papers, because we're going to talk about some topics today that may surprise you when it comes to, differences between what Dr. Wong is going to say and share between what your CPA may share. So, Dr. Wong, let's start with landlords, right?
Well, real quick,
Go ahead.
let's learn a little bit about Dr. Wong.
Okay, go ahead.
Fair. Tell us a little bit about yourself.
Well, I could take way more pains than probably anyone else in the CPA tax field. After I got my doctorate in economics at Berkeley in 74, I went off to Southeast Asia the last 2 years, 74, 75, when the whole thing collapsed. I was in Hong Kong in the spring of 75 when all the refugees are pouring out to the great Navy base. The U.S. had Subic Bay in Philippines and Clark Air Force Base. I was an independent contractor, so I called my own shots, whether it be with the Thai Navy or in Malaysia. And in 18 years of brutal martial arts, I've broken every finger and toe multiple times. So I don't think most people in the tax field, which are mainly paper pushers, could take 1/10 of the pain that I've had.
So let me ask you this. So when you broke in your fingers, did you win or did you lose?
Well, this caused me to lose in 79. I broke this finger. It's not a bad break at the national championships in Washington, D.C., Taekwondo. I got third place in Northern California, which qualified me to go to nationals, and it broke. And it's not a bad break, but the problem is the next 3 times, because it won't flex, I'd hit someone hard and it'd break again. So it forced my retirement from competition, but not from coaching. I helped coach the National Collegiate Championship Taekwondo team at UC Berkeley.
Oh, wow.
And I have a photo of me in Asia at the World Taekwondo headquarters in South Korea with part of the Olympic team. And I have a picture in China with my star student at Berkeley, Kim Il-Stach. Started with me was age 15, only 5'10", 165 pounds. Years later in China, he's 6'2", 210, and we're training before he got silver medal, second in the world full contact Taekwondo championship heavyweight division.
Wow.
So again,
So you're not only smart, but you're
Tough.
tough. Yeah.
well, you got to be tough when you tackle the IRS. If we had like the biathlon, which in the Winter Olympics is both cross-country skiing and shooting. If we had the biathlon of tax, where you argue tax law on behalf of your client, and then you have a fight, I think I would do well against the IRS.
I think you would.
What's the number one learning lesson you could share from being in martial arts all those years?
It's courage and discipline. I used to teach the basic martial arts classes at Berkeley, and out of 100 that start, we might have one that 5 years later has a black belt.
Wow.
And I'm talking about traditional martial arts, not what you see today, the last 40 years, where the martial arts studio, karate studio, is in a strip center, and they charge you every time you take a belt exam. So 2 years later, they get a black belt. Traditional martial arts, it's a minimum of 5 years.
Okay. So courage.
It's old school. It's old school. And I started in the 60s with Special Forces guys. We didn't even wear any protection, not even a cup to protect your Mayo part, because if you got hit, you remembered it. So that's
Yeah.
traditional
Yeah.
martial arts.
That's a good point.
Okay.
What and so, what did you study at Berkeley? What's your college background?
My undergrad, 4 years, University of Illinois, economics. But again, there I was different. My junior year, I combined my junior and senior year by taking proficiency exams. And my fourth year, I took the master's econ courses, started working on my dissertation. So I was the only one ever accepted to the PhD econ program at Berkeley, where in my application I gave the preliminary results of my dissertation research. So I didn't have to be a teaching assistant or research assistant. They gave me my own office starting in Berkeley. I got a Department of Labor grant, so I was able to hire 4 computer programmers. So again, that's very unusual. But the only time I've had success in America if I do it totally different than anyone else does.
Okay. All right. So University of Illinois, huh? Champaign?
That's right.
Fighting the line now.
Applied to 4 schools. This is the only one that took me.
Okay. All right. All right. So econ, economics, right?
Economics. And economics, the main thing you learn from economics, first of all, can I tell you, most PhDs in economics, certainly of that era, are totally worthless to do anything in the real world. Almost all their jobs, they became professors, or a few worked for government, and very few worked for banks. But this is true of almost anyone that gets a PhD in anything except STEM, science,
Right.
technology, engineering, math. If you're a PhD, you're book smart, you spent 10, 20 years or more, and you can't deal with people because you're isolated. And so in business, that goes for real estate, particularly if you're a real estate negotiator, you've got to understand people. So most PhDs really are pretty worthless as far as doing anything in the real world. And I never wanted to be that. The reason I got a PhD was my debt to my race. Before the 1970 census data, all racial categories on the census were either white or non-white. So my research at Berkeley was the relative economic status of Chinese, Japanese, black, and white men. I had access to the 70 census data, the first one that broke it down: white, Hispanic, black, Chinese, Japanese, Korean, Filipino. So I did the first study that actually had numbers. Before that, all the books on race were sociologists, historians, political scientists, but no one actually had the numbers. So that was my debt to my race, but it was nothing that what I wanted to do with my life.
Okay. All right.
So again, that's totally unique as well.
So you seem like you said CPAs or PhDs are pretty solo, so you're outgoing. You're totally different.
I was the shy guy with the PhD, and when I started the tax planning CPA firm in February, March of 1980 in San Francisco, a rookie PRP got me on my first media appearance, KCBS, 2 hours on KCBS in San Francisco. It's a powerful station equivalent to KTAR in Phoenix. And I had no idea I could touch the public. I'm a shy guy with a PhD economics CPA background. This was my first business. I got 3,000 letters and phone calls. Mind-blowing, because I talked not like a CPA. I just told stories. Here's how Jimmy Carter, who got elected president in November 76, here's how he legally owed 0 tax in 76. But he's a Democrat, the ex-Democrat governor of Georgia. And so he was embarrassed because most Democrats say we don't pay enough tax. So he wrote a $6,000 donation to IRS. And because he saved tax, he did it by buying $200,000 of peanut shelling equipment because the family business, he was a peanut farmer from Georgia. We had a 10% investment tax credit, $20,000 off your tax. So he had excess tax credit left after getting down to 0 in 76. So he went back to 1973 and recovered all the federal tax he paid. Back then the law is you could go back 3 years or carry forward 7 years. Today the law is, particularly with the 30% or higher solar tax credit, you can go back. The rule is I first have to get a client to close to 0 taxed in the current year. But if I've got extra solar credit, I can go back and recover all the federal tax paid in the last 3 years, or I can carry forward in excess for 22 years. This year, in 2025, the biggest refund I've got, my own State Farm agent, I won't mention her name because she's extremely well known in the Phoenix area. Yeah, around February, she called me happy. She had received a $220,000 refund check from IRS from the 2021 tax year and a letter saying another $70,000 is on the way.
Wow.
Since we set up a solar leasing program with business solar equipment at the end of 2019, every client that has gone back to recover up to all the federal tax paid in the last 3 years has recovered it. We've never had a single client been audited. And why would we? We're doing what the Democrats want, what the Clintons want, Obama wants, Biden wants, the Democrats, which is deal in clean energy, no fossil fuels. Every one of our machines, according to the state of California, which claims we have probably invented the only zero-emission technology that's commercially viable, every one of our machines saves 20 lives a year. So the state of California, based on medical studies, has said we've saved over 10,000 lives in the last 10 years.
Okay.
So who's against that? I don't care what your political persuasion is. Do you want 10,000 people to die?
Right.
Why, what's that stat from?
Okay, it's based on medical studies, starting with the Loma Linda University and Loma Linda Hospital study. Basically, here's the study, and it would scare the hell of everyone. If you put an emission from fossil fuels, particularly diesel, and it goes from 30 to 40 parts per cubic area, and you breathe it 1 hour a day, your chance of cancer goes up by 40%. That reading is terrible. The 10 worst cities are 6 in California, Houston, Phoenix, Las Vegas, and Denver. That reading for this type of black carbon emission in summer in Phoenix is 80.
Wow.
And we breathe it 24 hours a day. So based on many medical studies, and it comes from the diesel reefers, which are giant air conditioning units attached to food trailers. In a day, it takes as much diesel to cool the 48 to 53-foot refrigerator trailer as a semi-truck that pulls the trailer. We're the only ones in the world that have invented a solar-powered reefer. So every one of our machines, according to the state of California, saves 20 lives a year. Eventually, they, in their fantasy, to be so far to move up there, they would like us to replace 100,000 diesel reefers in California, saving untold lives.
Okay.
Of course, one of my clients, and I don't agree with it, says, if we're going to save lives in California, they don't deserve it. But
So-
I don't feel that. A life is a life, no matter when you're political, unless you're Antifa and you're actively working to subvert the U.S. Those lives, I don't think are worth saving.
So let's kind of tie it into real estate, right? So you've been CPA, you've been doing real estate and things like that.
I'm a serious
people.
real estate investor.
So as let's just say you like to tell stories. Let's use a story, right, that you have used before. I'm a real estate professional. I am a landlord. I own 5 houses. Hypothetically, how would you work my scenario in order to save me tax dollars, and what do you think would be a benefit?
Okay, the first thing I'm going to say is very controversial. If you ask CPAs how to save tax, whether it be 50 years ago, 30 years ago, today, they say have a bigger mortgage, maximize contributions to your IRA, 401k, and invest in real estate. The first thing I'm going to say is this: real estate may be a great investment to build your wealth. It doesn't save you any tax. And I'll give you an example.
Thank you. Yeah.
You buy a $500,000 starter rental house in a nice areas. Forget about Scottsdale prices. You're talking about Ahwatukee, South Tempe, Chandler, Gilbert. I don't know if you can find a starter $500,000 rental house, but you never have a problem with depreciation if you allocate 20% to the land. So that's $100,000.
Yep.
The land you can't depreciate because if a fire burns down the house, you can still use the land. So we got $400,000 left allocated to the house. ever since the 84, 86 tax law, it's 27.5-year depreciation life on residential real estate, rental houses, apartments, everything else, hotels, mini storage, office buildings, strip centers, 31-year life. So you take 400,000 building, divide by 27.5 years, it's about 14,500 a year of depreciation. If you're in a 25% tax bracket, it saves you $300 a month. But that's only if you place that rental house in service on January. If you place on December, you only get 1 month. So instead of $300 a month times 12, $3,600, you save $300. Now let's compare what kind of cash you needed. I used to be a one-man mortgage broker 20 years ago, one of the 11 businesses I started. To get a good interest rate on a non-owner occupied loan, you got to put 25% down. So 25% of 500 grand is 125,000. If you're lucky, there's only 5,000 of closing costs. There's only 10,000 of fix-up before you move your first tenant. So you had 140 grand cash to save 300 a month of tax. Now, I will tell you, the biggest tax savings is real estate is not at the beginning. It's not while you hold it. It's if you do the Section 1031 trade, you start with a fourplex, and I know Chinese female person in San Francisco started with one fourplex, and now she owns over $100 million of apartments, strip centers in California. She's worth over $100 million. She kept doing 1031 exchanges, deferred a gain, and here's the final exit plan. So you said you deferred the gain. The ideal exit plan, only from a tax viewpoint, if she dies holding that $100 million of equity in real estate, it's called step up in basis. She has 2 kids, a son and daughter. Now they inherit it, and they can sell it the next day with 0 gain. Wow. But most people don't want to die, so that's an unusual circumstance. But so the point is, real estate doesn't save you tax when you acquire it, while you hold it. Maybe if you hold it till you die, you save a lot of tax, and you can do 1031 exchanges to get bigger. The fourplex becomes an eightplex, 16plex, 64plex, and so forth. But as I've proven, mathematically, it doesn't save you tax. In contrast, that 140 grand for 2 of our 70,000 solar powered reefers, you'll get a minimum 30% solar credit. 30% of 142,000 is 42,000 off your tax, and you can deduct 119,000. But see, I've been using the formula which is called equipment leasing to save tax, maybe real estate to build long-term wealth, and private pensions to protect what you have. I've just been using the Jimmy Carter formula for 44 years. He bought peanut shelling equipment when there's only a 10% tax credit, but you can only deduct $5,000 in the first year. It's called Section 179, bonus depreciation. Today, after Trump tax law 1 and 2, you can buy millions of equipment and deduct it all in year 1. You don't even have to depreciate it.
So let's say that again.
But it's a Jimmy Carter formula, so don't anyone say you can't save tax. If it works for Reagan, if it works for Jimmy Carter, it works for giant multi-billion-dollar companies, my belief is the tax law should affect everyone, even beginning or intermediate investors in Phoenix in real estate.
So you said equipment leasing to save on taxes.
Real estate for long-term wealth creation, and private pensions to save when you want to take less risk and protect where it is, where Wall Street can't steal the money from you. And banks, if they go under, don't affect your private pension.
Okay. So what about if I'm an active investor, right? And I'm doing fix and flips.
Okay.
What's the aspect of that?
Yeah, once real estate investors find that the passive loss rules that came in with 86 law mean real estate can't really save them a lot of tax, they want to be a real estate dealer or real estate professional status. I'll give you an example. Suppose 40 years ago you're a surgeon in San Francisco, you make $1 million of wages, and you don't operate a medical practice. You get paid wages by the hospital, so you got no business deductions. You invest $2 million in a real estate investment trust sold by Wall Street. You get a 5% cash flow, $100,000 a year. But due to the depreciation, your total deductions are $200 grand. But you're a passive investor, so you can use 100,000 deductions. Also, your 100,000 of income, your K1 every year is a zero. But what drives you crazy? There's 100,000 a year every year. If I'm in the deal for 10 years, there's 1,000,000 of deductions I can't use. I want to lower my taxable income from 1,000,000 to 900, but you're a passive investor. So the only way to avoid that is you got to be a real estate dealer called a real estate professional status. This is what most investors, once they are serious about that, want to get. Can I tell you it's a mistake?
Why? Because we always hear that you want to become a real estate professional because you can save more on taxes versus just being a passive investor.
First of all, most of you can't qualify. The rule is you have to devote at least 750 hours a year to specified real estate activities, and being a real estate agent or mortgage broker does not count. Second, it's got to be over half of your working hours. So if you work a normal job, that's at least 40 hours times 50 weeks, 2,000 hours a year. Even if you spend every weekend, Saturday, Sunday, 15 hours is a lot. Absorbs your weekend times 50 weeks, that's 750 hours. That 750 hours is not half of 750 plus 2,000 your job, so you can't qualify. But let's suppose you could. You're successful enough in fixing, flipping, you give up your job. So that's all you do. Yes, the advantage is now there's no limit on your real estate deductions that you can take. No limit. But what do you give up? All your gains, there's no capital gains, is ordinary income, which now you're subject to 15.3% self-employment, Social Security, and Medicare tax. No capital gains. The highest rate federal tax is 37%. Highest capital gains is 20%, plus 3.8% net investment income tax. Next, you're not eligible for Section 1031 tax-deferred exchange, which is the big benefit of being in real estate. If you want to go from a 4-plex, an 8-plex, to 16-plex, to 64-plex, typically over 40 years. Next, you don't have installment sales. We know in certain parts of the economy, you buy a house, like you're a fix and flipper, you buy a house for $450,000. Let's make it easy and assume it's all cash. You had the cash. You spend $100,000 of renovations, and you're lucky you sell for $650 net of sales costs, like real estate commissions, closing costs. So you net $100,000. But in certain environments, you can't get that. So maybe you took $50,000 down and you carry a loan, a note, you're the bank, and now you get a good stream of income for 10, 20, 30 years. But you're a real estate dealer, real estate professional status. You're not eligible for installment sale. So you had $100,000 of profit. Even if you only took $50,000 of cash in, you got to recognize $100,000. So between 20% maximum capital gains and 3.8% net investment income, add state tax, let's round it off. Call 25% of $100,000 is $25,000 of tax owed. You got $50,000 down, so you're $25,000 positive cash flow. But a lot of people don't realize, and to structure a lot of deals, particularly when you want long-term income, you want to be the bank, but you got to recognize all the capital gains in the year, no matter how much or how little down payment you got.
I bet you catch a lot of flack from, I don't want to say normal CPAs, but it sounds like what you're saying is a direct contrary to what most CPAs teach.
Can I give you another example of where you Google, and whether you look at the field of financial planning, retirement planning, CPAs, what do they all say? Maximize your contributions to your IRA, 401k. Can I tell you, I'll prove that is absolutely wrong, and I'll give you the math. Okay. Engineers are good savers. 2/3 of my clients are highly analytical, engineers, IT, financial managers. So at 35, an engineer starts deducting $10,000 a year to his IRA and or 401k. He's in a 25% tax bracket, so he saves $2,500 a year of tax. He does it for 30 years from age 35 to 65. So he's contributed a total of $300,000, 30 years times $10,000. He's saved $75,000 of tax, 30 years times 2,500 annual tax savings, and he rides the stock market roller coaster because in a traditional IRA 401k, you can only invest in Wall Street products. It'd be a whole separate podcast to talk about a unique strategy to self-directed IRA. But now, so hallelujah, at 65, he's got $1 million. He's now a millionaire. But maybe his wife has a pension. He doesn't have to pull the money out to live on. So he lets it ride. At 75, it's doubled to $2 million. He now has 2 kids. Now the illegal alien fleeing the police, drunk driver, on drugs, head-on car crash. He's dead, and his wife's dead. We read about it, unfortunately, in Phoenix every single weekend. So now he's got 2 kids. So the $1 million goes, $1 million each kid, because kids want the money. They don't know tax planning.
Right.
So that $1 million is taxable on top of whatever a kid's taxable income is. Obviously, there's the 37% federal bracket. In Arizona, it's only 2.5%. In California, it'd be 13.3%. So let's just say it's at least about a 40% bracket. So 40% of $2 million goes out, $800,000 in tax. There's $1.2 million left. But let's look at the family. The poor engineer and his wife save $75,000 of tax. Now the kids pay $800,000 of tax. See, they're not all dumb at the U.S. Department of Treasury.
Mm-hmm.
The government's collecting over 10 times the tax from the family than what they saved. It was a beautiful mousetrap called the conventional wisdom is maximize your deductions. Take the cheese. Take the deduction now. And look, they never talk about what happens at the end of the road. So that's the math. I can anytime I take a stand or talk about conventional wisdom and I destroy it, it's all based on the math. It's not based on my opinion.
Because I know I was reading when it comes to like IRAs and everything like that, big business push the IRAs to the employees because then the business didn't have to pay that pension, right? Because there was more that the companies had to pay up. So they said, hey, you know what, let's push this on the employees. The employees contribute and we don't have to contribute as much. And plus it was, you know, a handshake deal for Wall Street because you can only invest in Wall Street products.
Oh, yeah, Wall Street loves, and also it became a bad thing to the employees because when companies went under the dot-com crash, 2000 or 2003, Enron was the poster boy for the fraud.
Right.
Enron had funded the pensions in the 401ks with Enron stock. So when Enron
Went under.
under, you had thousands of employees, no job. Nothing, no pension, nothing in the 401k. And we go back further, Frank Lorenzo, Google this. He's the CEO of a number of airlines and like Continental Airlines. I remember being outside O'Hare Airport in Chicago, and a number of Continental airline pilots were picketing. What he did with the merge, when he would merge an airline with another, he would steal the pension money from the employees. So when it went under, there's no money in the pension. From more recent cases, I've heard from pilots on Delta, United Airlines, TWA, Pan American. I've heard the same thing happen in their case.
Yeah.
Wow. So as AZREIA members, you know, single family, small multifamily, what's your biggest tip for us to get on track and be successful?
Sure. Let me tell you the tax strategy for a fix and flipper. Well, we already showed you that you're really not going to save that much current tax. The big thing is the Section 1031 if you're a real estate appreciator. To save tax, let's say you're a successful fix and flipper and you make $100,000 net, $200,000 net. Well, this may sound like I'm going against what I previously said, but I'm going to give you the full story.
Okay.
To get the tax deductions, you want to maximize contributions to your IRA or 401k, but you want to do it in a Roth format. But if you want the immediate tax savings, here's what you do. For 2026, the maximum you can put into an IRA is $7,500 if you're 49 or under. If you're 50 and over, it's $8,600.
Oh, you do 86,
Now,
40.
Now, these two guys are too young for that, of course, so they're not eligible. But if you want to deduct more, so you go to the standard 401k, it's $24,500 if you're 49 or under. If you're age 50 or over, it's an extra $8,000. Next, you go to the solo 401k. You do this if there's no employees except you and your wife. You are now both the employee and employer, so the total is a lot. The total amount you can put in is about $80,000. Now, and there's one thing beyond that, something I've used, it's almost never used. It's called the Defined Benefit Plan. There are 3 years where I would contribute over $200,000. So again, now you're in that ticking tax time bomb of traditional IRAs, 401ks. But here's the difference. Now, the key to avoid that ticking tax bomb of your $2 million being hit with $800,000 tax, now we got to do Roth conversions.
Mm-hmm.
I've not met anyone from the CPA Wall Street world that has a formula on how you can convert 300, 500,000, a million to Roth without paying tax, because it creates 300, 500,000, a million tax. Well, we do that through our solar business equipment. We find that you do a $500,000 Roth conversions, it takes $370,000 machines to offset all the tax. Why? You get a 30 to 70% solar tax credit and immediate 100% deduction of your business. So basically,
But Dr. Wong, I'm a real estate professional. Why do I need equipment?
Again, the equipment is for tax savings. So you've contributed $500,000 to your traditional IRA 401k,
Right.
using the solo 401k, the traditional 401k. But now that's a ticking tax time bomb. You now want to convert that to Roth, because let's say you use 3 of our solar machines. There are other strategies, and now you have $500,000 in a Roth conversion, and you didn't pay federal tax. Now with the $500,000, suppose you're a great fix and flipper, and you need only $10,000 to tie down a deal. You're using hard money lending, so you have to pull off capital, and you now can make a $50,000 profit. You want to use your self-directed Roth IRA, debt $10,000 or $20,000 to tie it on the deal, or use an option technique. And if you make $50,000, it's all tax-free. If you've got $500,000 there and it takes $20,000 to tie down a deal, you can literally do 25 deals. Now imagine 25 times $50,000 profit per deal. That's $1.25 million. It's all tax-free. And now you only have the original $500,000. Let's say you got another $1 million. Now you got $1.5 million, and you keep doing that. Do you see how quickly your wealth can skyrocket?
So my experience growing up as a real estate investor is, you don't know anything normally, right? And it's like, okay, I got a bookkeeper. Then you realize a CPA, they got 1,000 files. They're not advisors. Then you got to go find someone that does like wealth planning, and you know. So what is your thoughts on that? Like, how can we get better at understanding taxes?
Can I tell you, due to tough penalties put on anyone that does a tax return, whether you're H&R Block or CPAs, I'm talking about the 81, 82, 84, 86 tax laws subcourse. If we were in a seminar, I could scroll through pages of it. The penalties are so onerous, they turn the tax field, with a few exceptions, into tax preparation, not tax planning. So you talked about a CPA. He's got one partner. So 2 CPAs doing 1,000 tax returns, which is a huge number, and they're making a good living. And let's say 5% of the 1,000 or 50 are successful real estate investors, business owners, doctors, and they owe $50,000 to $100,000 a year of tax. Is the CPA going to jeopardize his license to do any tax planning for those 50 and jeopardize his ability to do tax returns for the 950? Because most people stay with the tax preparer, whether it's H&R Block or CPA. Look at the revenue he can earn over the next 10, 20 years with those clients, even if he never adds more. So it's all risk versus reward. IRS has put the penalty so high, the risk is high. What's the benefit? If you save someone tax, does the stingy cheap, taxpayer, give him a spiff. If he saves that client 50,000, does he get an extra 1,000?
No.
See, again, every time I've had success, I've done things differently. Now, in Arizona, I don't do what I did in California, but in California, I'm easy. I'll see anyone in Arizona. But in California, 40 years ago, 45 years ago, you had to owe at least 100,000 of tax to see me. It was 5,000 up front, and you signed a 5-year contract where you paid me 20% of the taxes saved. I don't do that in Arizona. I'm easy in Arizona. I see a lot of people even at no charge as a public service. But I'll give you an example. Bosch spark plugs, Bosch fuel injectors, Bosch appliances. The German guy that ran Bosch in the U.S., he sold a multi-million-dollar apartment building in '85 in Sacramento. He would have owed $500,000 tax. I was asked clients, how much tax do you want to pay? We got him to zero. So he wrote me 2 checks, $5,000 up front and $100,000, which is 20% of the $500,000 saved. And I used that money. Then I acquired my first hotel in '85 in San Diego. A small hotel turned into a celebrity hotel for celebrities like Whitney Houston.
Well, you saving all of the good stuff. You didn't tell us that.
Yeah, and this is still my best creative deal. From Mitsui Manufacturing Bank, a giant Japanese bank that took over a failed San Diego bank. Because in the 80s, we had 3,000 savings loans, 1,000 banks that went under. It's called the banking savings loan crisis. So the Japanese bank, it wasn't their loss. So basically, it was 10% down. So it took part of the $500,000 we saved, and for our client, Everhard, 10% down. So at the $105,000 he paid me, and he got deducted, I used it to furnish it because we bought it empty, 4 years old, never occupied. So I put Everhard, the client, on the deed for 45%. So that's how he got the hotel, no money down. I got the hotel, no money down. And I asked him, do you think Uncle Sam deserves anything? He said, I've been paying lots of tax for 40 years. No, let's not put Uncle Sam on the deed. So Uncle Sam got nothing. So that's how I financed my first hotel, no money down.
I love it. See, we got to have more of those. A lot of great info. We do have to start winding down.
Sure.
It was a great time with
So
you.
it's not just tax savings.
Yeah.
What do you do if you save 30, 50, 100,000 a year tax? Do something. If you're a real estate investor, the best thing is create a Roth IRA and grow that pile of money, because now all your gains are tax-free for the rest of your life. If you have a younger wife or husband, after you die, for the rest of your spouse's life, and for your kids or grandkids, the first 10 years they inherit, hopefully your millions in a Roth IRA. For 10 years, no matter how much they earn, there's zero tax.
That's great.
Now, how do you beat that?
Yeah, so these are all good tips, that our listeners and our members really need to pick up.
But it all fits as part of a system. It's not just saving tax for tax savings' sake. What are you going to do with the money now?
Right.
That's a great question.
Yeah. So how can we get in touch with you, Dr. Wong, if our members have more questions they wanted to ask you, some questions about tax savings?
Well, it's real simple. Here's the easiest way to get education. First of all, I've not changed my phone number in 30 years. It's 480-706-0177. Now, or you go to my website, www.drharoldwong.com. And if you go to publications, you can read every article since April of 2019. I write the monthly financial column for 6 newspapers in the Southeast Valley. Before that, for 8 years, I wrote the only column on money for the Arizona Republic, the largest daily newspaper in Arizona. My website used to have hundreds of articles, but when I got a new website developer 5 years ago, said, don't inundate them with hundreds of articles, because the Republic, twice a month, will give me a half a page of the Republic. And so I just, all the articles since April 2019. Now, many of them are tax, many are real estate, many are on retirement planning, many are the economy, and most of them are timeless. So you can read that.
Give us your contact info again. What was
your
website?
The website is www.drharoldwong.com. drharoldwong.com. Now, if you spell it out, Dr. Harold Wong.com, that works as well.
Okay.
Call me at 480-706-0177. I want to warn you, you cannot text me. I'm probably the only one in any real estate room or any seminar room where I met Michael Delpre. I do not own a cell phone on purpose.
There you go.
And here's why. Some of the consultations that are 2 hours, 3 hours, even 5.5 hours straight. And I give people the rarest. Where else can you see a national expert, whether it be business, law, tax, real estate, whatever your field is, and he gives you his total undivided attention.
Yeah.
And I tell people,
rare.
if I had a cell phone and I was sending or receiving 50, 100 texts a day, I cannot give you my total undivided attention. So that's why I don't have a cell phone. Okay. And when you call, you will call a 40-year-old phone made by General Electric. I can't screen anyone out. There's not even a screen.
Oh, so even if you don't like them, you got to answer.
There's not even a screen. So most of the calls I get a robo sales call, but I have to pick up every call. It will go to my home office. I have a physical office as well, but the home office, and so you can call me. I've not changed my phone number in 30 years.
All right. So we got 480-706-0177, and go to Dr. or drharoldwong.com.
And you can read every article published since April 2019.
Thank you for being here.
Yeah, well, Dr. Wong, it was our pleasure for you being here, man. We're going to definitely have to have you back because you're a wealth of information. You got tons of stuff. I mean, we didn't even get into all of the questions that we have, but we really appreciate you for being here.
Well, I appreciate it. I mean, it took me over 50 years to acquire this knowledge. My doctorate in economics was 74. Hard to believe we're 2025, soon to be 2026. So it's over 50 years.
Yep.
Now, some people kid, you don't look a day over 90, Dr. Wong.
So, guys, you know exactly what to do. Reach out to Dr. Wong. If you need additional information about Dr. Wong, you have his contact info. But go to AZREIA.org. That's AZREIA.org. If you're new to the community, if you're new to Arizona, this is your best place to get real estate information about Arizona real estate. So if it's East Valley, West Valley, Central Phoenix, the outskirts, the tertiary areas, Buckeye, we have it all right here for you. So we'll love to see you, love for you to be a part of the community, and thank you for being a loyal listener.
And can I give a plug? It's not recent, but for over 5 years, I was a member of AZREIA, and I found their meetings very good.
Well, thank you so much.
Appreciate that.
All right.
Thanks for listening to the AZREIA Show with your hosts, Marcus Maloney and Mike Del Prete. We hope you enjoyed this episode. If you found this information valuable, head over to AZREIA.org and learn more about our community.